Welcome to This Explainer. Today, we're going to look way beyond the shiny surface of gold and uncover its three modern lives: a complex physical commodity, a geopolitical shield, and a futuristic recycled asset. So let me ask you a quick question. What is the most powerful asset in the world? You might naturally assume the ultimate store of value today is purely digital, or maybe backed by a major superpower. But as we'll see, this ancient metal still quietly controls the global economy. The sheer scale of what we're dealing with here is absolutely staggering. By 2025, official global central bank gold holdings achieved near parity with foreign U.S. Treasury securities for the first time since 1996. It is a massive structural shift in exactly how the world holds its wealth. To understand why this is happening, we're going to trace its journey. First, the complex gold supply chain. Second, central banks and de-dollarization. And third, the urban mining boom. Section 1. The complex gold supply chain. Gold rarely leaves a mine ready for a bank vault. Think of it kind of like a recipe. It transforms from raw ore into a concentrate, gets baked into this semi-refined mixture called doré, and only then does it become the market-grade bullion we all recognize. Selling gold is not just a simple matter of price times weight. It's a sequence of highly complex transformations. And because gold is found in such tiny concentrations, even a microscopic measurement error could literally cost millions. Enter the assay. Think of it as the ultimate financial lie detector test. It's the standard method used to quantify gold content, designed specifically to reduce bias and turn uncertainty into defensible, trusted measurements. It basically dictates exactly how buyers and sellers share the financial risks. At the end of the day, selling gold is essentially selling trust. The whole trade relies heavily on strict chain of custody records, complex tolling agreements, and just meticulous compliance to prevent costly disputes. You've got to account for penalties for impurities and constantly weigh tolling versus outright purchase. Honestly, if the paperwork is sloppy, the metal simply stops moving. Section 2. Central banks and de-dollarization. Now, against this backdrop of global economic shifts, the US dollar is actually facing some structural pressure. Its share of global reserves has fallen down to 57.74%, which is a really meaningful retreat from decades of total dominance. To put that shift into perspective, think about the number 1,894. That is the massive tonnage of gold currently held by Russia. After the unprecedented freezing of Russian central bank assets, the message was pretty clear to non-aligned governments: dollar exposure can be a geopolitical vulnerability. This illustrates exactly why specific emerging economies like China, Turkey, and India are heavily accumulating gold in response. But here's the surprising part. It's actually not all driven by geopolitics. While sanctions definitely get the headlines, most central banks are buying gold for very orthodox portfolio reasons. 82% rely on its historical stability, 78% point to crisis performance, and 75% really value the absence of default risk. Only 32% are actively aiming to reduce their dollar exposure. And this data reveals something fascinating. Gold doesn't always act as a safe haven across the board. It actually has a U-shaped performance. It pretty much sleeps quietly during everyday normal market conditions, but then wakes up and surges during extreme stock market crashes or massive bull runs. It responds selectively and only under very specific extreme conditions. Section 3. The urban mining boom. So, looking to the future, urban mining is incredibly serious business. Refinery procurement managers are actually pretty blunt about this. They will not accept secondary materials below 99.95% purity without massive price penalties that completely destroy recycler margins. You can't just melt old phones down in a pot on your stove. It requires advanced hydrometallurgical refining to meet those strict London Bullion Market Association purity standards. The financial stakes here are massive. This booming urban mining market is projected to reach over $75 million by 2036, and it's completely dominated by the highly lucrative extraction of precious metals, sitting right at 52%. This is largely because global e-waste generation is just exploding, fueled by over 60 million metric tons generated every single year. These discarded electronics provide highly concentrated feedstock streams. And get this, the gold grades hidden inside these electronics are actually far above the grades found in traditional ore deposits deep in the earth. We are watching this global shift happen in real time. Driven by strict extended producer responsibility regulations and a really critical need for mineral security, nations are racing to heavily invest. We're seeing China at 15% growth and Germany at 14.5%, heavily funding AI-powered robotic sorting and circular economy infrastructure. With recovery rates now exceeding 95%, urban mining is directly challenging the cost structure of primary virgin extraction. It's wild to think about, but the physical reality of gold has come completely full circle. We're now pulling it out of old circuit boards almost as efficiently as we once pulled it out of the ground. So I want to leave you with this final thought. Is the next great gold rush sitting in your discarded electronics store right now? As you look around your home today, consider how those old smartphones gathering dust are quietly becoming the most vital part of the future global supply chain. Thank you so much for joining me for this explainer. Keep exploring the hidden value all around you, and I'll catch you next time.